watching Money Talk Viewpoint, and I'm Chantel Leeson. Successful businesses have one very common factor, and that is they have an ongoing stream of the right prospects who become clients or customers. And that's good marketing. And that's what we do. Reach out to one of our specialists today at moneytalkviewpoint.org. Let me have our first guest on for the day. And actually, he's our only guest for the day. He's also a co-host on our show. And this is Stuart Kruse. Stuart is a chartered financial analyst, a Quant Investment Advisor, TED Talk speaker, published author, a venture capitalist, and he's the CFO for Virtual Family Office. Stuart, thank you for being a co-host, but thank you today particularly for sharing yourself with our audience. How are you?
I'm doing great. Thank you for that lovely introduction. You make me sound better than I actually am, or at least that my kids think I am.
Well, kids love their dads. You're a great dad. You talk about your kids, and I appreciate that. You know, I wanted to ask you, how did you happen to get started in asset management?
Well, that's an interesting journey. I started off in chemical engineering because I just gravitate towards those kind of sciences, mathematical approach. And quite frankly, when I was in that area, one of my buddies was getting his MBA, and I thought that couldn't have been the most boring thing to do on the planet. I just couldn't conceive of why he'd want to listen to somebody talk about finance all day. And then not very much longer after that, I went to get my own MBA and just kind of looked for a home, really. And I was in some venture capital. We started a real estate investment trust of golf courses back in the late 90s. As you can imagine, in the late 90s, when every .com was exploding, nobody wanted a REIT paying 6%. So that failed eventually. And ultimately, when I was saying, hey, what do I want to be when I grow up? I decided to explore the asset management space. So I got my desk in the late 90s with Lehman Brothers out in New York. So that was the journey.
Good start. That was a great start there. Let me ask you now, I noticed that you moved into the quant investment space. What made you focus on quant investing? Quantitative investing, I'm sorry.
Quantitative, same thing. Well, as I mentioned, my event and just the way I think is mathematical. And so when I first entered the business of finance, it became really apparent, especially on the retail side, that investment advisors, portfolio managers, mutual fund managers tend to not be very good at their job. Like most retail advisors are more relationship managers. They spend much more time, and there's nothing wrong with being a relationship manager. I mean, people need to have their hands held through crises like we're going through right now. But for the most part, they don't manage the portfolios, they don't do the work. And then when they farm it out to these portfolio managers or to kind of rely on analysts, when you look at how those performances are, it's actually pretty bad. And so in doing that, I was kind of struggling with how can I add value and how could I sell, because that's what I was being asked to do. How can I sell to Mrs. Jones this portfolio or a group of portfolio managers that are underperforming over time? And then when I was at Bear Stearns and Lehman Brothers, I had to sell it at a premium price. So underperformance at a premium price. And I was having a real hard time with reconciling those two things. And I honestly was like, I might have to get out of this business because I don't want to sell. I want to add value, right? And so I said, well, all right, let's take a step back. If I were managing money, I don't have the resources to create a team of analysts and build all that infrastructure out, but it doesn't seem to work anyway. So let's look at a different route. And I just asked a very simple fundamental question. Are there characteristics of companies and stocks in today's point in time that tend to lead towards outperformance a year from that date? It's a pretty simple question. Like, do I buy low PE stocks that tend to be at a good value? Or do I buy high PE stocks that tend to be those growthy fund names that can explode in the upward trajectory? And I just didn't know the answer to that question. So what should I do? So I did the work. I did the math is what happened. And I started looking at all the different characteristics to see if there were any statistical advantages in the marketplace. And I said, if there are these advantages, why not just buy those stocks? Let's forget all the other stuff and just buy the stocks with those advantages now. I'm not going to be right every time, but in theory, I should be right more often than I'm wrong. And my best analogy is like Las Vegas, right? So when I personally walk into Las Vegas, I'm a player and I'm gambling because the odds are against me. I have walked out of Las Vegas ahead. Like for the weekend, I've come out, maybe a few $100s ahead, but there's a mathematical certainty that if I continue to play, and I'm not cheating or counting cards or whatever, but if I continue to play, then I will end up losing that money. But as the house doesn't certainly win every single hand, or else the player would never show up. But the house always wins over time, and it becomes a mathematical certainty that they win. And so that's what I wanted for my clients. I wanted to slant the odds in their favor so that if I invested their money with the odds in their favor enough times over enough years with enough strategies, that eventually become a mathematical certainty, just like the house wanting to play more hands against more players.
Something, I got to say something about what you just said. What I hear in your statement is that you really care about what you're doing. You care about the results of the clients. And I'm saying that because what's happening in our industry is that there are two sides of the equation. And some people just sell because they're going to make a commission. But I think what people want to hear is that not all financial professionals are out just to make a commission. We want to do the right job. And I think you just made that point very clear.
Yeah, I think it's important. I just had somebody ask this question, like, what would you do or how would you operate your business if you couldn't get paid unless you perform for the client? Not that, hey, you already got the money and I'm just trying to keep them on board, but what if you didn't get paid unless you performed? And so we actually have a pay for performance option. I'm fine with that. Like, I'm completely fine with that. If I don't help the clients reach their goals, why are you paying me? If my plumber doesn't fix my sink, I'm not going to pay him, right? I mean, why wouldn't I adhere to the same standards to some extent, right? If I can't help them, don't pay me.
Wow. I like the fact that plumber, my dad owned a plumbing business. So I know that feeling of paying, make sure the plumber is paid.
Yeah.
What I like above all is that you're letting people know that there are quality people out here. Not only do you understand the fundamentals and the technicals of what you are doing, but you're doing it for the sake of giving the client the best results. And you're not just running out numbers.
Right. 100%.
I understand that you've got a book coming out pretty soon. I hope I'm not jumping too far ahead. Can you share with us about the book getting published pretty soon here?
I'm trying. So I'm in editing phase right now. And as anybody who's written a book, or at least a lot of people, it can be a multi-year process. And this is exactly what happened with mine. But the book is called License to Steal. So the genesis was when I first got my Series 7. I was at Lehman Brothers. We were studying. I was in training. Series 7 is your license that gives you the ability to trade stocks. And so I got my Series 7. And one of the bigger producers that were at Lehman Brothers, this guy makes multi-million dollars a year. He comes by, he's like, hey, did you pass? We all got our results, right? Did you pass? I said, yeah, I passed. He said, congratulations. You now have a license to steal. I was like, oh, that's not what I was looking for, right? Again, that's the mentality. I was in New York. It's a pretty cutthroaty environment in some cases. And that was kind of his mentality. And I'm like, that's not what I want my mentality to be, that I want to be able to steal from my clients. I can generate trades to actually take money out of their account. That was not what I was hoping for. So the book is License to Steal: How to Turn Wall Street Greed into Your Gain. And what it is all about is quantitative investing, kind of pulling back the curtain on most of my quantitative research that talks about, what happens when you buy a low PE stock versus high PE. I didn't really mention that, but what I found is buying low PE stocks tends to win over time. And it tends to win like the last couple of years. Well, since 2021, that method has crushed it. But prior to that, the 2 or 3 years before, post-COVID, when the government was throwing a bunch of money at the economy, expensive stocks were getting more expensive. Buying higher PE stocks won. So when you look at over the last, let's say 50 or 60 years, in any 3-year rolling window, buying a basket of low PE stocks tends to outperform 2/3 of the time. So 1/3 of the time in a 3-year rolling window, it does not outperform. So that's by definition 3 years of underperformance. And then you got to imagine there are periods of 4 and 5 years where that whole strategy would underperform. And of course, no client's going to wait 5 years. I mean, unless you're actually Warren Buffett, who says sometimes I have to wait 10 years, but no client is going to wait on you for 5 years and go, look, be patient. It's coming. The performance is coming, I swear. And so it talks about a bunch of other strategies that tend to work over time. And as you build them into a multi-factor model, how can you outperform the S&P 500 when 60 to 80% of fund managers actually underperform?
You know, actually, that's in that Warren Buffett style, though. He's a value investor. He's for low PE stocks.
Yeah.
And I think it's just after many people saw the movie called Wolf of Wall Street. That was the exact opposite.
Exact opposite.
That was the highest PE you could find to get churn and burn type of process.
Exactly right.
And that's the kind of person you don't want.
And so buying these kind of stocks and making these investments are certainly not sexy. And you're not going to be in the locker room or on the country club talking about, hey, I bought, I don't know, Tesla. Like Tesla is a very hard stock to value on its valuation. And so according to my methodologies, I'm not saying Tesla's a bad stock or a bad company. It's iconic, right? It's amazing. But from a valuation standpoint,